and get us started again. You guys, I get a good
Wait,
chuckle.
I'm sorry, where can we have those recorded? Did you send
The link to recording is on the same, it's on the same page as the resources in the slides. I'll put it in the Slack channel here for you.
Sorry, just the chat, please. Yes, thank you very much.
Yeah. So it's on that, on the Get Trajectory page. All right. All right. Well, everybody, welcome back. I was teasing Randa about Cairo time versus Bahrain time and Seattle time. They run a little squishier. So, and you guys don't have traffic to deal with today. So it's not like you can say like, the traffic was really bad, which is always the case. So I'm going to post so the link that I've given you so far with all of the program information also has the video and the audio from yesterday. So I'll post that in the, let's go to everybody. So in case you want to have yesterday's video as well. I didn't catch all of it yesterday. We do have both sessions today. It'll be up for 30 days. So, and then there's no sense in paying Zoom past 30 days at this point. All right, so let's quick summary and kind of in go-to-market. I added this slide if you're following along at home. In case the pieces that we just covered weren't explicit enough, and you don't have to follow my format, but one of the slides you need to do for the 22nd is your go-to-market slide. Your go-to-market slide is really addressing at the big picture level, how are you gonna get your 10, 100, 1,000 customers? What's your plan? What are your activities? In my world, that's a combination of revenue model and of course pricing, because it goes into your financial model, but also what are the activities you're going to do over the next 4 months when you join the program. So I want you to have a plan together to sell the team on when you get there that says, hey, day one that we get here, we're going to go do these things. That involves marketing and who owns it. So the owner and the channels and the spend. It involves sales, the model, who owns it, and what are the tactics? What are you gonna go do, right? And the business development, the owner, and the targets. So if you use this slide for your go-to-market, I will be wildly disappointed because I hope you have more detail than that. But the idea that I'm after here is what's your 4-month plan post-program for your go-to-market activities. And your go-to-market activities are marketing activities, sales activities, revenue model choices, pricing, and here's our go-to-market. If it's trade shows, if it's email, like what are the activities you're going to do to get people to the top of the funnel? So I wanted to take something that was implicit in the previous conversation and make it explicit around what you need to do for that slide. So that's one of your 10 slides.
By spend, hi Dave. By spend, you mean the budget itself, a figure, or just the spending channels?
Ideally, your budget would be part of your financial model. It's a question of, again, that's slide 10 in your order of things. If you have time to do it, great. If you don't have time to do it, so you're going to be, there's 26 teams, I think, and 10 teams are going to get in.
If you for the next meeting or something to discuss in the business model. The
more detail you have around what you're going to do, the more likely you are to get into the program. If you phone this one in and copy and paste this slide as your activity and just talk to it, you probably won't get in the programs, and I'll see you at the next boot camp, right? Because you'll be applying for the next one. So spend some time, figure out what your activity is. Some of you are laughing. You know, we see some recycled folks, right? Because if you're not ready for this one, that's okay. You can get ready for the next one. All right. So next topic is really product roadmap and company roadmap. So what I want you to understand here, and again, this is going to be in supporting slides at most. I would put this into your slide 11 category, not in slide 10. So these are not a priority to get done by the 22nd, but no, this is where you sync up your planning with your financial model and your product roadmap. So product roadmap, company roadmap is really all about who do we need to hire, when, to do what. And it's part of your use of proceeds that you're going to get for your investment from FLAT6. What are you going to spend the money on? In addition to spending on marketing, who are you going to hire, when are you going to hire, and what do you expect them to deliver? So That's what you're after from your roadmap perspective. But it starts with your vision. Like, what's your product vision and where do you want it to go? Do me a favor as a founder. As founders, we merge together our vision with our base camp. So that the top of Everest with the base camp, I want you to separate those two things out for what you're going to pitch on the 22nd. You need to tease out that you have a big picture vision and a big TAM, but you need to tell me what problem you're solving today and why you believe it to be true. So start with the problem, not with the product. We got a theme there. What are you going to ship first? What are you going to ship next? If you look at the next 4 quarters in the next year, you have 4 months with the FLAT6 team. Over the next year, how many engineers do you need to hire? What features you're going to ship first? What are the major builds you're going to release? And I would put them into quarters, right? So there's a level of precision if you're saying, like, we're going to put it into this month. Maybe, but if you don't hire the person in time, you're not going to make the month. The best you're going to do is make the quarter. Okay. Go ahead, Kimi.
Dave, this part of the presentation, the product vision would be a part of the presentation, the 4 minutes presentation? I don't think so, right?
No, it goes into your financial. These are part of your assumptions that go into your financial model.
Okay.
So if you think about it as like, I have some technical debt I need to pay, or there's a new feature we need to ship, but I'm not going to ship that new feature until I hire another engineer. Okay. Great. If I hire that engineer in August, they get ramped up, and in September, it's going to take them 2 months to build. I'm at November. So I can't show revenue for that new product until November because I have to ship it first. But I am going to show expense for that new product in my financial model. Okay. Good. So just part of your planning process. So minimum viable product, most of you are already here, but just to speak to it, you're going to have a narrow list of features, not everything you could build or everything you could ship. You're going to get your narrow list of features what I'm going to ship first. For many of you, your next build should be a PowerPoint version and demoing something that can be slideware before it's built. It's totally fine. And slideware is just using PowerPoint or Keynote to demo a product before you actually have a product. One of the things I'd encourage you to get really good at as a founder and CEO or in the founder roles is what are the workflows? I think of as, or you'll hear them called often 1X UX, first time user experience. Is the customer wowed by it, or is it cumbersome? Are you trying to get too much on the page or not? So what's the customer workflow you're going to use? How are you going to onboard that customer from a customer success standpoint? Is it easy to use? Is it hard to use? But you should have a sense of like first-time user experience there too. And keep doing customer development interviews, obviously, through this process. So when you look at the product roadmap, this will be a document that you use to help communicate with the team. It'll be a document you use to help communicate what's on your budget. And it also informs what you're going to do for your hiring plan. So that product roadmap should be quarterly, based on budget available, not if come, or not waiting on investments. So like this is the plan we're going to do with the team we have. We have 14 people today, or 3 or 5. And given that workload, here's what we're going to accomplish on this path. With that additional capital, we'll accelerate these things, but you need to have them prioritized before you get to the plan, before you get to the event. Also based on just available talent, right? In this market, for us in Seattle, it's hard to find talent and technical talent anyway, even in spite of the current economic situation. So based on budget, based on people, you need to allow for ramp time. Like how long is it going to take you to recruit that person? So don't underestimate the time to ramp.
Dave, if I may ask.
Yeah, please.
I mean, we are bootstrapped, so we will have a certain projection if without funding and with funding. So in the financial plan, should we talk about both scenarios, or only post-funding or only pre-funding?
Yeah, I would
continue to do the business for the coming years, whether the funding comes or not, right?
Yeah, the way I always think
about it is, the growth trajectory
is,
would be different depending on whether the funding comes or not, and how much is the funding.
Yeah, I build my plan based on what I know. And then if I get funding, I take stuff from future quarters and I move them forward. Right. And I think that way what you're showing is, hey, one way or the other, right? If the message you communicate is, hey, we're just waiting to find money until we go build this thing, the answer is you're not going to find money. Like no investor wants to fund that. If it's like, hey, we're going to keep bootstrapping and doing this, and here's how we're going to do it between now and the time we find money. And once we hit these milestones, part of the message you're communicating is the more advanced your product and customer gets, the more traction you have. The more traction you have, the less of your company you have to sell, right? So think of it as an inverted X, right? So I have traction, I sell less of my company. Early days, I have no traction and I have no money, I sell more of my company. Right? The more traction I get, the less of my company I sell. So most of the time, so if you're starting with 75% of the equity and your co-founder has 25, just to keep the math simple, after 2 rounds of funding, you're no longer going to have 51%. The more traction you get before you get money, the more the company you'll have after the second round of funding, right? So, and the thing you don't want to do is that a friend sell recently, and after 9 years, she was the founder of the company. She had 11% of the company was all that she had left after 3 rounds of funding. That's a lot of work for 11%. Now,
I have a question, please.
Yeah.
For the financial projections, while we are presenting for an investor of FLAT6 Labs, the financial projection will put that the one we are working on already, or the one that we are projecting to have based on the scenario that we got the investment, especially that in our ask, when we are asking for fund, we need to put where we are going to use this fund. So we need to make another financial projection and plan based on the fund that we are raising. So what's your...
I'm sorry, I picked out. This was, I think, the question I was also asking.
Yeah. So again, the way I would position it is, this is my plan with or without the money, with your additional capital. Here's how we're going to prioritize our spend. We're hiring an engineer, we're doing marketing. Like, tell me where you're going to spend that money over the next 4 months, but don't build your financial plan without that. Otherwise you're wasting your time building a financial plan if you don't get the money, right? You've sunk a bunch of hours in it. If you do your basic financial plan and the budget without the dollars and you get the dollars, congratulations, you've just accelerated stuff forward. But do the one financial plan assuming no additional capital, right? At least from FLAT6.
Yeah.
So you can do it however you'd like. If it was me, that's the way I would do it.
Okay, so for the financial projection, okay, we'll make it according to our plan. But for the ask that we are going to use this amount of money, I think we should convince them after we get this amount of money where we are going to go. So we need to make another plan or what? I don't know how to be going.
Hopefully you're not making another plan. You're just accelerating your existing plan.
Sorry, can I jump in?
Yeah, please.
So this is
you can always jump in, Albert.
So
that's your prerogative.
Thanks. Ultimately, we want to see where you want to take this business. What's your vision, right? Exactly like Dave said, you're moving these businesses forward with or without us, right? So what are you doing at the moment? And what will you do with additional help from us, financial help from us? So I just would like to see what you're doing with your business, with or without FLAT6 Labs money.
Mm-hmm. Okay, I got it. But I think in Q&A in the pitch we need to be knowing this exact fund where it will go or how we are going to use it. It can accelerate, for example, 1 year we can acquire more market share, something like that. We need to be knowing about what we will achieve with this money, I think, right?
I mean, I think we're saying the same thing, right? So where do you want to take your business? With £500 or with £1,000, regardless. How do you want to spend money going forward? Do you want to spend it on marketing? Do you want to spend it on hiring a bigger team? Do you want to spend it on buying an office? You know? So this is ultimately what we want to see. What are you planning to do with your business? It's not every dollar, how are you going to spend it if I invest in you? It's more on a high level, how do you want to see your business going forward?
Mm-hmm. Just one thing, I got it. Thank you, Albert. But for the fund itself, we need to put percentages, like we're going to spend 50% on marketing, 30% on team, or something like that, or just saying that we are going to spend it on some points or some activities.
So it's very good for you to know how you want to spend the money. The exact cost breakdown, I highly doubt that you know it. If we're talking about exact percentages, I highly doubt anyone knows it at this point. But you have a rough idea. You want to spend on marketing, you want to spend on hiring a workforce, etc., etc. So this is the message that needs to come off more than, oh, I want to spend 52.1% on digital marketing.
Totally the case. There's a level of precision that you're applying in percentages. I'm after big picture stuff, and so's the team, right? We're gonna hire an engineer. We're gonna test out marketing spend. We're gonna get our sales motion going. Like, tell me in general what the big blocks are. Do not spend time doing your budget to a level of precision that is not justified. Make
Okay.
sense?
Thank you very much. Thank
It'll
you.
save you. It'll save you a ton of time.
I have a quick question here. I've heard before that it's not, I don't know if it's like, I was told that it was not good to put the hiring process within your ask. So you don't mention your hiring because investor might not want to know or spend for you to build your company hiring wise. You should be able to hire yourself at least the minimal that you would need to bring your product up. And so does that mean if I'm reading at any time that I have to mention expansion of the team, even if I'm doing it, or I don't have to mention it?
Well, I think it comes down to what do you need? And Albert, feel free to weigh in here as well. If you need help finding technical talent or you need help finding marketing talent, your investors look at it and say, we know you're going to use our money for that. And I may be able to help you if you tell me what you need. If you don't tell me what you need, I'm going to lean towards and favor companies who have a plan, right? The selection committee is my guess. That's the way they're going to do it. But Albert, I'll let you weigh in and then we'll move on. Okay.
Yeah, I'll second what Dave said, because it's also a natural progression, right? As your business grows, you need to grow the team. So this is what, again, we want to see. Where do you see your business going? So if the business is growing at X amount, you'll obviously need a bigger team to do so. So who are the integral key people who you need, who you don't currently have, that will cost you money in the future? So I would say, just a short answer to your question, yes, I'd like to know who you plan on hiring in the near future.
All right.
Okay, thank you.
Yeah, and again, tell a cogent story about what you're planning to do. That's super important. So along that line, let's talk about your general cost to build, right? So in estimating your cost, hopefully you have a specification that you've written. Hopefully the team knows what you're working on, and hopefully they know your next level of priorities. So your design and your workflow has to be in that. Hopefully you have design work done too. Some of you I know from demos yesterday, I gave some feedback to that I would take some time even between now and the 22nd and spend a little bit of money, even a few $100s on design to clean stuff up and make stuff look like a product instead of making it look like just a PowerPoint. It's too abstract. And then get your design and your flow feedback from your customers as you're continuing to roll out and improve the products. But include design in the product. Like, one of the things that I'll tell you is that sometimes I look at products and it's like having a plumber do your interior design of your house, right? They're like, but the plumbing's beautiful and the code doesn't need to look pretty. If it is ugly and it doesn't work, you won't get a second chance. If it's beautiful and it doesn't work, you'll probably get a second chance. So for those of you who don't have a designer or access to a designer, assume that you're going to spend a little bit of money on design. It's not super expensive, but it'll definitely pay off for you. I'm not going to bother you with MVP mechanics because most of you are already there. From a company roadmap perspective, here are the big picture quarterly targets that you're after. And again, this does not go in your deck. This is a supporting slide, but it informs your financial model. So again, I'm going to blow through it. It's there. You can come back to it at a later time. You do not need it as part of your 10 slides. So on a quarter by quarter basis over the next 4 quarters, what are the major milestones you're going to ship from the product standpoint? Are you launching another major feature? Are you doing a rebuild of the platform? Like, what are the big picture things you're going to do, and how many people are required to do that? From a key hiring perspective, do you need a marketing manager or a marketing director? Or are you going to hire a marketing consulting firm to help you figure out your advertising spend? What are the people or budget required to do that? Is it 3,000 EGP? Is it 30,000 EGP, right? How many customers do you expect to onboard every quarter, knowing what you know today? So so if you think about this as a spreadsheet, the way we do it, I'll make sure I post my version of it we use for our board report. We have an end of quarter, and the end of quarter says exiting number of customers, exiting cash in the bank, number of months until we're out of cash. Now, for a lot of you, you've been bootstrapping it and you've been out of cash for a while. Totally get it. I've lived in that world, right? So, but once you raise money as an investor, I want to know that you're using the money well and that you're not running too close to the edge, right? So on a planning standpoint, I'm trying to say major milestones. When I finish the quarter, how many customers do I expect to have? And you need to document that for you. Like, we need to have a goal. Like, we need our first 10 customers by the end of this next quarter. Great, right? Will you hit it? Don't know. But if you don't have a goal, for sure you'll miss it. So get a goal of what you want to have from a customer perspective. How much revenue should you have at the end of that quarter? And how much cash available, and what's your cash out date? So if you think about this as burn, it's cash in the bank divided by monthly burn equals 3.2 months equals -3 months equals 30 months, right? I don't care what it is, but what I care for you as a founder is I want you to have visibility to, oh my gosh, when do I run out of cash? And like I said, for some of you, the answer is we're bootstrapping it. We've already ran out of cash. Totally okay, right? But what I want you to get a discipline of is how much cash do I have in the bank and how long will it last me, right? So that's the basics of it. You're going to do then is your roadmap again is not dependent on fundraising. And at the same time, where I'm after in the longer term, past this one, when you get this into an operational plan, you're always looking at 18 months out. And the reason you're looking at 18 months is you're trying to double your enterprise value in 18 months. That's the only reason. When people say, how much money should I fundraise for? Like if I'm doing an ask, your ask should be for 18 months of runway, right? That allows you to hit particular milestones that allows you to double the business. So should I raise for 6 months? Should I raise for 2 years? You should raise for 18 months, right? It's just kind of it's a way to get you to do, I can raise the capital, I can deploy the capital, and then I can start raising capital again. But if you take drips and drabs and you take a little bit at a time and you're always raising money, you'll never have enough cash to deploy, and you'll always be busy fundraising rather than out selling and working on partnerships and working on product. So go raise enough money for 18 months, deploy the capital, go raise again. So that's the mechanic you should be following. Ultimately, this is going to map to your financial model. That's where it needs to sync. And then you'll add on your use of proceeds. If we get 40,000 USD, we're going to spend it this way. And roughly you've already mapped it out. So now you're just moving stuff forward. So it's not don't overthink this one. It's just simply a question of like, we're just trying to put together a plan so the team knows what you're going to do if you get the capital from the program, if you get the capital from the investors at demo day. I'm not going to bother you with the eye chart. Highlight your key milestones for your pitch. Like, what are the key milestones you hope to achieve in the 4 months that you're at the team? So, if they're major ship dates, first revenue, major customer sale. One side note here is if we as founders get super enthusiastic about our last meeting the customer was positive. If you're talking to not FLAT6 because they don't operate this way, but if you're talking to a regular investor and you're like, we just had a great customer meeting and they could be our biggest customer ever. And my answer for most investors is going to be, that's awesome. Let me know when you get them closed. Because you've just given me a reason to wait instead of a reason to write a check. So I'm not saying hide those things. I'm just saying never create a reason to wait when there's an urgency to close, right? If you're out raising capital, you want to create a reason to create competition, make sure there's other investors involved, right? You don't want to have the only investor give them a reason to wait. So major releases are, for example, a reason to wait. So. All right, so that's your basics on milestones, product roadmap, company roadmap. Again, the categories are going to be, I'll post this in the supporting slides that'll have an Excel doc or a Google Sheet that basically is customer acquisition on a quarterly basis, how much you're going to spend, how many customers do you hope to acquire, revenue on a quarterly basis, product, what major milestones we're going to ship that quarter, people, how many people will we be, we're 3, we're going to go to 13, whatever the number is, operations and finance, who's doing ops and finance, who's focused on customer success and customer retention and making sure you have money in the bank. And then one sidelight I'll add for you is important things we're not doing now. So my friend called it the Itindi list. So important things we're not doing yet. The idea with that is, as founders, we always see a next new thing we could do, right? And we're a little bit of like, I don't remember what the movie was, but about the dog who was always chasing the squirrel, and it would be like, squirrel, right? And as founders, there's always something we think might be the next new thing we're going to do. As you grow the team, it's a problem because the team wants to be excited about what you're doing, but you also need to have a clear path that you're trying to set and be disciplined about. So, and as founders, we seldom meet one of our ideas we don't like. So the discipline piece of this is, oh, that's a really great idea. We should do that in Q3 next year, unless we get the capital. Because you've already given, if you have a technical co-founder and a team, you've already told them what you want them to ship. If you come back and flip-flop on them about what you want, they're going to get frustrated because they want you to have a clear vision and give some clear direction so they know what they're going to go build. So just know that you need to have an important list of things you're not doing yet. Is a good place to remember what those things are. And if you decide to if you get capital, you can prioritize them. But if you don't get additional capital, the odds of you doing what you're doing today plus more, especially if you're a non-technical founder and you don't have a good grasp yet of how long it takes to build product, right? So for those of you who are technical, you know what I mean. All right, so let's talk about fundraising fundamentals. So let me reiterate as we close on that topic, that does not go into your 10 slides. It's part of your background that helps you do your financial model. It's a good discipline for you to use going forward. Everybody clear on that? Eye chart should not be in that slides. All right, fundraising. So from a fundraising 101 perspective, you're after what's called stage appropriate capital, not all capital. So stage appropriate capital is, FLAT6 is an early stage investor. If I was representing the family office, our average check is $1 million. As much as you may like $1 million, the fact is you're not ready for $1 million. Most of you, some of you might be close, right? But we're a later stage investor. So we don't invest in pre-revenue companies. Will investors take your meeting? Probably, right? Is it a good use of your time as a founder? No. Like you're after stage appropriate capital. So the thing you want to ask when you talk to the investors is, do you invest in our category, our market? And do you invest in our stage? So do you like fashion and marketplaces and pre-revenue companies? And if the answer is, oh, we only invest in late stage companies and we only invest in SaaS companies. Great, good to know. It's not really worth your time to go do a meeting with that company and that investor. So, and the problem for us as founders is we're always looking for good news. So you'll come out of that meeting, you're like, that was a great meeting. And the investor's looking at it going, that was really interesting, but we'll never write a check for it. So I want you to save yourself some time and make sure you qualify the investor in advance. Is that an arrogant thing to do? Not really. Like you're trying to make the most of people's time. So if you call and talk with Dave and you say, hey, Dave, we're an early stage company, we're pre-revenue, but we have a super big total addressable market and we're doing X, Y, and Z, it's super cool. Do you invest in that stage of companies? If my answer is, oh, that's really awesome, I like what you're doing, but we don't invest that early, can I keep you on my list, Dave, to reach out to you when we get to a future point that's more appropriate stage-wise? Sure, I'd love to hear that, right? But should you go have coffee or lunch with me now? No, right? So you're looking for the investor who's the right stage appropriate for what you're doing it now. Realize as you raise capital, you will end up with control shifts within the company. So you're going to end up with board members, you're going to end up with board observers, and ultimately those things are going to change the control of how the company is run. As you take outside money, you take the terms of that outside money with you. So just be aware of that. It's not something you need to be scared of, but it's something you need to be aware of, for sure. Every round of funding, you're going to get diluted between 25 and 33%, 25 and 35% on the range. So every round of funding is you're going to give up that much of additional equity in the form of new shares. They're going to allow the investor to buy into your company. So they're not buying your shares like we talked about yesterday. They're buying new shares that you create out of thin air, but that will cause dilution. So if you're at 75% today and you take 25% dilution, right? You're going to be diluted by 25% in this round. You're going to be diluted by 25% in the next round. You're roughly going to be 37.5% of the company after the second round of funding. So you don't want to take more capital than you need, right? But you always want to take capital that the terms you find agreeable, right? So you can't optimize around your equity percentage. You need to optimize around, excuse me, having enough cash in the
Dave,
bank.
sorry, Dave, to ask, is 25% or 35%, it's regardless the amount you're raising? Yani, regardless.
Generally, that's the case from a stage appropriate perspective.
Okay.
And what I mean by that
Regardless,
is
the one is joining the company taking how much as in terms of shares, or yani, it will be diluting the whole shares by 20-35%, regardless, even if it's taking 5%. I'm raising fund for 5%.
well, if you so it's a combination of what's the right stage, enough capital for 18 months,
Yes.
and who's writing the check, right? So there's I think very much like the conversation we had with Albert about what's my use of proceeds broken down by percentage. There implies a level of precision that doesn't exist in fundraising. So in fundraising, if my average check is $1 million, I'm going to look for the stage of things where I invest $1 million. We on average like to have between 10 and 15% ownership stake of the company. So what that means then is we would look at deals where our check would be part of a $3 million raise because we're not a lead investor. It's a family office. As the fund that I was with before, we were a lead investor, right? So we would look at deals that were doing a $3 million raise because we would contribute $1 million, right? But we didn't want to own 100% of the round. And we typically wouldn't write checks less than $1 million, right? So if you were a smaller check. So what you end up optimizing around, just to be clear, is you're going to take a check. If you talk to an investor that writes $10 million checks, it's not stage appropriate. If you talk to somebody who's writing a $300,000 check, they may be part of a syndicate that gets you to $1 million. But on average, if you look across the board of all startups and the fundraising, on average, each round takes dilution between 25 and 35%. Right? So you may end up just selling 10% on the first round, great. But on average, each round.
And if I'm selling 10% at the first round, how much this will reflect in dilution? This was my question.
So
10%,
if you want
5% also.
Yeah. So if you have 1 million shares and you sell 10%, you're going to have 1.1 million shares total outstanding. So your stake is going to be 90%.
Okay. So we're diluting by 10% then, not 25 or 35, right?
Yeah. It depends if that cash is enough money to get you to the milestone.
Okay.
Right? Otherwise, you're going to end up raising a small amount, a small amount, a small amount, a small amount. Okay. And it really depends on valuation. So the concept here is pre-money value and post-money value, just to get the kind of fundraising 101. What's your company worth the immediately before you take the additional capital? That's pre-money value. What's your company worth immediately after you take the fund, right? That's post-money value. In the early stage where you guys are at, I'm sad to tell you there's not an accurate formula for doing this. Right? It's based on how well we like you as the team and how big we think the market is. And there's some general heuristics around fundraising. The more mature the company gets, the more there's actual data to base the valuation on the data. But at the early stage, right, there's information asymmetry here. The VCs know the deals they've done, the deals they missed, and the deals they passed on. And if your deal is out of range with what normal heuristics and range is, they're just probably going to pass, right? So you come in and you're like, we're going to raise 10% on a $3 million pre and we don't have any revenue. And the answer is, good luck with that. You're not going to raise anything, right? So anybody watch Shark Tank before?
Yes.
Okay.
Yeah.
So this is a little Shark Tanky. It's a little bit of a game, right? If you come in and you ask for much too high of a value, you're going to get 0. If you ask for too low of a value, right, they're going to end up selling more of the company than you need to sell. So part of the guess.
I have a quick question because we had actually that was about a year ago before we even launched any of our products. It was just MVP at that time. We got offered through one of the banks. Like they provided an investor for our product or our company, and when we sat with them, they offered us to take 51% of the company for quite a high value. plus doing all the work from hiring the teams, buying an office or renting an office, and all that. At this time, I thought the ask was too much for take 51% for what they're offering. But I don't know, is it at that early stage, was that a good thing or a bad thing?
Well, I always hate to give up 51% early, right? I mean,
Yeah.
I don't mind giving up 51% over 2 rounds of funding, but the odds are, you know, that's kind of a weird offer for an early stage company. So unless it's some strategic value to them. So most of the time, so private equity and venture capital is different, right? And banks are just different still. Typically, a bank is going to give you money based on your personal ability to pay that money back.
Okay.
As an investor, for Albert and I as investors, we don't want to run the company, right?
Yeah.
We want to give you money so you can accelerate the growth of the company.
Yeah.
But we don't want to run it. Like that doesn't, FLAT6 doesn't scale that way. I don't scale that way, right? I want to give you money, have you go hit your milestones and run it. Now, private equity, on the other hand, later stage capital, is going to want to buy 51% control the company and then have you do the work and pay you like an employee. That's just.
I think this was kind of the type of the investor they were.
Yeah, and there's a lot of first-time investors or early investors who invest like they do in real estate, and they want control, right? And they're not typical venture capitalists for sure, right? VC, I will tell you, having worked as both a VC and as a founder, VCs don't want to work that hard, and that's no slight on Albert and the team, right? The answer is I want to get a decent price on the valuation. I want to help you grow the company. I want to see it exit big, but I don't actually want to step in and run the company. So go back to fundraising 101 here. So you're going to get diluted on every round. You just need to think about your dilution, but you can't micromanage dilution. And then recognize that sometimes your lead investor will also most of the time, your lead investor will put a board member on your board, and bad board members will not help your enterprise value. Sometimes they're there just to watch their money. Sometimes they're there and they actually add value. So be aware that don't just take anybody on the board, right? You should have a chance to do your due diligence on them too. So if an investor comes along and says, hey, we want to invest in your company, but Dave wants to be on the board, then you should ask for references for Dave of other CEOs where Dave's been on the board and make sure that that's a good thing. So you get control over those things too. It's part of the negotiation. All right, so what are you raising for? We talked about your use of proceeds earlier, but just to reiterate, it's 18 months on average. We don't want to be too short. You don't want to, if you raise for too long, you're raising more money than you need, or you're taking dilution you don't need. You're going to hit product milestones. You're going to hit customer and revenue milestones, and that becomes what's called use of proceeds. So in your docs, somebody will say, "What are you going to use the money for?" That's called use of proceeds. So in general, angels are investing in you and your passion. They typically have to check with somebody else. They don't have to, but like if I'm going to write an angel check, I'm going to tell my wife what I'm writing the angel check for and why I'm excited about your company. Typically, they've made money in a particular sector. So they may have made money in real estate. They may have made money in tech. My personal experience of having invested in multiple segments is when I invest in an area I don't know, I tend to lose all that money. So my wife's in pharma, right? So her company's trying to cure cancer. I don't know anything about curing cancer. Like I wish I did. That would be awesome, but I don't. So I invest in things I know. I don't invest in things I don't know. So if you were doing a B2C app focused on kids, I would be like, that's awesome. Congratulations. I don't know anything about that. Right? If you're doing something focused on government, I'd be like, that's awesome. Good luck. I don't know anything about that. Right? There's things I know well and there's things I don't. As an investor, that tends to be what guides my investment decisions, at least the smarter investors. Typical in these terms are the deal type is a note with a convertible, with a cap, or it can be a safe, which is the equivalent of a note, but it's an agreement to buy future equity. And they'll talk with you about this on the legal time tomorrow. I typically want pro rata participation. So if I come in with convertible debt, ultimately, I don't want you to pay the debt back. Ultimately, I want stock. But doing convertible debt means you don't have to price the value of the company today. right? So the answer is we're early. We don't know exactly what kind of traction we're going to have, but you need the money. So a convertible debt goes with a cap that says, hey, if it's a runaway success, I'll still benefit, right? Or if it's a failure, I'd be first getting paid. I'm not planning on getting that money back. I want you to use that money to grow the company, but ultimately I want to own stock. So because I want to have an exit that's aligned with your exit. Those early investors should have what's called pro rata rights. So if I buy 2% of the company as an angel, then your earliest investors are the ones who took the most risk on you. And ideally, if they have pro rata rights, it means I can keep my 2%. So if you double the value of the company and I put in 25,000, and if I want to keep my 2%, I have to add another 50,000. I should have the ability to do that because I took the riskiest investment. Now, not everybody does, but know that as an angel investor, I just want you to appreciate the fact that I was early with you and you took the risk with you. When you get money at later stages, give me a chance to keep my percentage because I'd like to own my 2%. The highest risk in friends and family. So information asymmetry is kind of funny in venture, right? In later stage venture, the VCs know the information and you don't. In earlier, your friends and family don't know the information and you do. So make sure your friends and family get the best deal, not the worst deal. Like I've come along with some deals where I was the first institutional money in, and our price was below what the friends and family paid. So they had raised $200,000 from friends and family at a higher price than we were willing to pay. So we went back and had them fix that and give their friends and family a better deal that tied to our deal, because that was the right thing to do, right? They took the riskiest example and the riskiest cast. So
Dave,
yeah.
if I may ask just a question here. In the previous slide, I don't think I got the two types, which is maybe I'm not aware, or I don't have a strong financial background actually to understand both. But the first two, the convertible note and the prorate participation, I didn't get them well. Yeah, I didn't know the difference.
Yeah, so they're going to go over the mechanics with you tomorrow. I think, Albert, you guys use a safe note?
We can in some instances. It's not.
Okay. But you use typical convertible note with a cap, or do you guys take equity at this stage?
The standard offering is just equity based.
Got it.
Very later stage companies, we could potentially do safe notes with an equity cap.
Okay. So the attorneys are going to go over this with you tomorrow during the legal section about what the terms are that FLAT6 is offering. FLAT6 is going to own equity for a particular dollar amount. There's a slight range variance in there, but the idea there is they're pricing the company at a particular value, right? If you're of the 26 companies, some of them have revenue and pretty good scalable revenue. That'll be a bit of a push on the valuation, right? Some of you are pre-revenue and you'd be like, I'd be happy to get that value, right? But there's a wide variance within those companies. So that's buying equity, and they're giving you cash and they're buying stock in your company. With that stock, they have rights to vote those shares. They have rights to keep their percentages, right? There's a whole set of rights that come with that, and the lawyers will explain that to you tomorrow. The other
maybe I will get more details about FLAT6 Labs tomorrow, but I'm asking just for my info, the difference between those two, convertible notes and the prorate.
A convertible note with a cap is a way for me to put money into your company today without having to price the value.
Okay.
Right. So if I want to put $25,000 in, I think the company's worth $1 million, but we don't want to price it. You don't want to price it yet, right? Because you don't know what it's worth yet. You think you're going to get a big customer in, and you think the value is going to go up. The idea there is I put $25,000 in, make it 100,000 just to keep it easy. Make it $100,000 in, and you have a cap of $1 million, which means my $100,000 will buy 10% of the company at a future date. And then when you take an investment as a conversion, you're going to price my round in, and I'm typically going to get my stock plus my accrued interest is going to come in the form of shares as well. So if I accrue $5,000 of interest, I'm going to get my $100,000 of equity plus my $5,000 of interest is going to come over in the form of shares as a share purchase. So that's how convertible note with a cap work. It's just mechanics. And if you're super curious about these things, there's 2 great books on it. I'll make sure I post it on the website. One is called Secrets of Sand Hill Road. There's no actual secrets involved, but it's a great clickbaity title. And it'll break down both all the details of term sheets and the control issues that goes with term sheets. And the other is Brad Feld's book called Venture Deals. Both of them are great books on the topic and super helpful.
Okay.
Pro rata participation is, I bought 10% of the company. When you do your next round of funding, let's say the company went from $1 million to $2 million, then if I had pro rata rights, I could keep my 10%, but I would have to invest more money to keep that 10%.
With no dilution.
Yeah, and well, you're going to take more dilution, but I can keep my percentage as long as I write a bigger check.
Okay.
So I was 100,000 before, but now you've doubled the value. So to keep my 10%, I need to increase another 100,000, right?
So I'll match whatever the current investor is paying. I'll match them and keep my own without dilution.
Yep. And if you as a founder wanted to keep your stake, you could put more money in too, but most of the time founders don't, right? Because we've already spent all of our money to get to this point, right? It's the typical what happens. Anyway, that's how angels work in general.
Thank you. Yes.
Early stage we mentioned is risk capital. So the closer you get to knowing your numbers, the closer you get to your forecast, you're moving things out of risk capital and into growth capital. So VCs invest other people's money. So I mentioned yesterday, if I took limited partner money from you all, and I went to go invest in a company, and I told you I was going to invest in Mina, in tech, in early stage, and I invested in pharma in the US at late stage. You guys, if I lost that money, you guys would look at me and say, like, we're going to sue you, right? So that doesn't happen. So that's why you ask the question for early stage investors, do you invest in our type of deal? Because they have a charter. And when they have a charter, that's what they're going to invest in. We're always looking for, on the VC, we're looking for deals that can return the fund. So when I look at all of the 26 companies that are there, I'm looking at it going, which ones do I think could give me a 10X or 20X on my investment, right? Because I know half of them are going to fail. So I want to make sure that I get a great return on some of them. It doesn't mean they won't invest in you if you're not a 10X or 20X, but they are looking for that 10X or 20X first. So later stage capital is growth stage capital. Growth stage capital is really all about, we're just adding fuel to the fire, right? You've already proven out your numbers. We already know your math. And so my friend who did DocuSign, they did a round of funding right before they went public. That was a $400 million round of funding. It was the easiest round of funding they ever raised because they knew all the math, they knew all the data. Everything was just about growth, 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 growth. And it was the fastest round of funding they ever raised, as opposed to the early days where people were like, I don't know if this digital signature thing's going to work. Right. And we look back on it now and go, didn't take much vision to go, yeah, that'll probably work. So strategics at this point may want to invest in your company. So somebody who may be your buyer ultimately, it's not always bad. Sometimes it's bad. If they're taking a board seat, I would definitely not take strategics money. And then you'll also find, like, your 51% mark, people are in the later stage are looking for more control. They can do that with both terms and voting rights. So just know that there's ways to get more control. As you get diluted down, they have more control and power. As long as you're hitting your numbers, most of the time the answer is rock on. But if you miss a quarter, look to get replaced. Like, just know that that's their part of their formula. From a process standpoint, I would tell you that this is an enterprise sales process. Right. So what you're running is you're going out to do recruiting of potential investors, is you're looking for a broad funnel of qualified prospects that you can start to build relationships with, that you can have optionality and choices of whose money you take. So all the investors will tell you, we want to build relationships with you first. Like, I would like to think that's true, but most of the time it's not really true. Right. So, and VCs will tell you that they're value added capital and there's about more than money. I would like to tell you that's true, but usually it's just about money. Right. Because if you're a VC, you can't sit on 8 boards. It's really hard to do. Right. And add value with. So your top of the funnel, your research, you're going to look for companies like yours, like we did for the research project yesterday. You're going to look at who invested in those companies early. Maybe they've exited. And you're going to reach out to those investors and say, hey, I see you invested in so-and-so company. It's a lot like us, but we're in Mina. and they were in the US, is that, you know, if you knew they made money and the company went public or whatever, the answer is, would you like to see another company like this that's emerging in MENA that could do that same thing again, right? And what you'll find is if you ask for advice, you are likely to get money. If you ask for money, you're likely to get advice. So what you want to do is build a list of potential prospects in investors, both angels and early stage VCs, who know the market and have seen people make money in this market before. If they haven't seen people make money in this market before, they probably won't invest in you. So just know that if I have to learn both a new product in a new category and I have to learn MENA, the answer is I'm probably not going to learn it. If I've made money in the category before and I just have to understand MENA better, I probably would give it a look, right? But if you have to train me on two of them, I probably won't do it. I'm going to do that in Crunchbase. I'm going to do that in PitchBook. I can do it in TechNation out of the UK. I can do it on AngelList. And then I'm also going to look for competitive deals where there's been exits. So who made money in a deal like mine before? And then I'm going to create a forwardable email. And that email is going to have my tagline and value proposition, my target customer. It looks an awful lot like the Mad Libs pitch we've been doing with a little more data. And it's something you can ask somebody, if Albert's in your deal and you're like, hey, we're trying to meet this such and such investor, would you make an introduction for me? And if Albert says yes, you want to immediately forward him an email that says, hey, Albert, thanks for forwarding this to Dave. Hi, Dave, we're doing a company that's doing blah, blah, blah. Like, don't make it Albert's job to write your summary email for you. That's crazy. He doesn't know your latest status, you do. And the easier you make it for people to refer you, the better it will be. And there's a great example, and there's a blog post of a summary email and how to do that from there. You're gonna build a list of targets. You're gonna look on LinkedIn for introductions. You're gonna ask for a warm introduction. Hey, Dave, can you introduce me to Albert? Hey, Albert, can you introduce me to Dave? You can do cold emails. They won't be as effective, but introductions are better, but not necessarily required. I'll look at deals that come in through LinkedIn, as long as they don't say dear sir, or they're not a copy and paste, or dear F name, right? Because they totally didn't take the time to even put in my name, or they didn't research it. Hey Dave, we're doing a B2C company in Brazil. I don't invest in Brazil, right? I don't speak Portuguese. So if they did a little bit of research, they'd find out what I like and what I invest in. If they've done no research, I'm gonna give them a thanks, but no thanks. Do they have board experience at your stage if they're investing? And can they help you with any strategic introductions? So for example, am I an industry expert or a vertical market expert where I can help you into introductions? Or if you're in Seattle, can I help you with talent, right? But I can't really help you guys with talent in MENA. So it's not a good strategic ask for me. All right, first impressions matter. You're gonna build that list, you're gonna look on LinkedIn, you're gonna do your research in advance. Do the research before you reach out to the person. Have they invested in the market in the stage before, stage appropriate capital? Looks like this is a duplicate of the previous slide. Crazy. And then you're gonna do the monthly updates. So we've moved from the monthly updates of customer updates. Now we're gonna do monthly updates for investor updates. And the summary on these ones are slightly different than the customer updates. It's here's what we thought, here's what we learned, here's what we're doing about it. And the last piece is here's where we could use your help. So you're gonna keep me informed. I can't tell you, there's been a number of times that we've invested in companies that I've just followed their monthly updates for 3 or 4 months, and they're making regular progress, and they hit an inflection point, and I'm like, we should meet, right? Versus, you know, if monthly updates do the work for you, so you don't have to. So you should be preparing a monthly update for your investor prospects just to make your job easier, keeping them warm and regular. 30-day intervals, you can use MailChimp for free. It's not super expensive to do this for any other things. Some last do's and don'ts on fundraising. Make sure you keep your eye on the ball. One thing you don't want to do in this process is to miss your numbers. So while you're in the midst of fundraising, being super busy in fundraising, your sales tank, or you miss a major release date, or you have some huge churn. one of the things we always laugh about in is the first board meeting after we close an investment, because we're like, what thing happened that they neglected to tell us about before we closed? And there's always something, right? It's like, if you have customer concentration, which means you have too much, all of your revenue is with one customer or two customers instead of broadly distributed across your customers. You're like, yeah, we lost a customer, or yeah, one of our employees just left. But there's always something at the first board meeting that's a little painful. So keep your eye on the ball while you're doing this and make sure that you hit your numbers. So the last thing you want to do is like, we're getting ready to close, we're getting ready to wire. The end of the month comes and they say, hey, send me your financials for month end so I can add them to my due diligence file. And your numbers come over and you missed your target, right? So bad news to investors should travel fast, not slow. Like, if you want me to come back and be an investor again in future rounds, you should communicate with me. I've had companies in our portfolio that we invest, and then we don't hear from them until it's time for them to raise money again in 12 to 18 months. And I'm like, I have no idea what you're working on, right? So versus a monthly update would keep me warm and knowing, oh yeah, you guys are gonna raise money again soon? Good to know. Like, I can either decide to do it or not do it. I can keep my pro rata stake or not. So in the case, what's happening on the inside there is, as a venture capitalist, I'm going to update my investment memo, and I'm going to make a recommendation to the team of whether we should reinvest or not. But if you give me no data and then give me a deadline to fund, I'm probably going to just say no, because you haven't communicated with me through that time. Yep. You manage the process. Don't let the investor manage the process. So this is all about a process that you're doing. And if the investor's like, yeah, we're in, and they don't wire and they don't wire and they don't wire, they're probably not actually in. So you need to manage the expectations and manage the process. Like I talked about before, you need to qualify the investor. Like, is this the type of deal, Dave, that you really do? And it's not an over ask, right? The other thing I would encourage you about, there's this concept of due diligence, and I'm not going to go into it today. It's in, I think it's in some of the supporting slides. If not, I've written about it as well. You don't need to worry about it yet. However, to know that when I'm doing due diligence, I'm going to go look at your corporate docs, your financials, and your forecast. Those are usually in what's called a data room, or they could be in a Dropbox or a Box account. So I'm going to go in and look at that information. I'm also, if I'm the lead investor, going to ask to call some of your customers. For many of you, you have very few customers. So my encouragement to you is, great, Dave, I'm happy to let you call my customers. I'm going to be on the call with you and I'm going to record them. So if I have other investors who want to talk to the customers, I can share with them the recorded file. Right? Because my customers are super busy and I have a very small number of them and I don't want you to piss them off, right? And be like, oh, how come? Because if 6 different VCs call your 5 biggest customers and then nobody invests, then your customers are like, maybe there's something wrong with the company, right? So it's something you just need to think through. You have to manage the process. You're always looking for options, right? So optionality is good. Finding multiple lead investors is good. Post FLAT6, they'll help you go out and find investors for the next round of funding, and they'll participate, but their FLAT6 will not price the round. So, and that's actually a good thing, right? So if they're internally supporting you and getting you ready for the next round of funding, they can bring additional capital to the table, but they're not going to be your lead. They're looking for you to go find a lead. So Albert, have you guys ever led a follow-on round? He may have stepped away. Anyway, my guess is most accelerator programs will not lead a follow-on round. So it's just out of character, and it's not what the industry expects. The industry is looking for somebody else to price the round. All right. If there's an elephant in the room, call it out, right?
Sorry, Dave, you were breaking up there.
Oh, yeah, no worries. So my question to Albert was, have you guys ever led a follow-on round to a portfolio company, or do you always look for outside leads?
We look for outside leads as not to overinflate our initial valuations.
Yeah, and the reason simple, you guys, is that they're looking for somebody else to price the round versus looking for them to price it internally. So, and it's actually a good thing for you. A couple of don'ts. Once you've raised the first round, second round of funding, or a seed round 1 and seed round 2, don't get less than 6 months of cash in the bank. Like you put the company at risk and you put your fundraising effort at risk. Don't hide the ball on any bad news. This is the inverse version of talking about the elephant. Don't be too transparent. So what I mean by that is, personally, like I've done a deal before where we did the term sheet, we led the deal, and we were syndicating to finish out the round. And the CEO was like super needy. It was like a bad dating relationship. Oh my gosh, I'm so glad you guys did that. We were so close to the edge. We may not have made it. And I'm like, I don't know that I want to hear this right now. Like, we're not done closing and funding yet. We're still syndicating the deal. If I'm out syndicating the deal, what that means for me as a VC is I'm introducing you to other VCs who can help close the round. If other VCs give me feedback that I didn't understand or I didn't find in due diligence, I may not fund your round. So, don't be too needy on the back end of this. Like, be honest, but don't be too needy. Don't let investors miss deadlines as well. So an example a friend of mine went through a number of years ago was they had a buyer. There was a breakup fee if the buyer elected not to close the deal. They never put the breakup fee in escrow. And then they elected not to close on time, which meant they were going to run out of money and not be able to fund last payroll. And since the money wasn't in escrow, the buyer was like, hey, we'll renegotiate the deal and just get a better deal. And since the CEO had never required the money to be in escrow, he ended up closing the company down. So you need to manage the process. You need to manage the deadlines. If a VC says they're going to wire you on the 16th and they don't, I would call them on the 15th and say, just confirm you guys are wiring tomorrow. If you get to the 16th and they don't, I would be on the phone with them before the banks close. Hey, I thought you guys were going to close today. What's going on? Oh, well, maybe, like, you don't want any of that. Manage the process and you can own it. All right, from a conclusions perspective, a broad funnel gives you the most choices and optionality. Make sure you're talking to other investors. Don't settle in on just one investor when you come out of the program. Like, go find multiple investors. How they interact with you is going to be part of how they judge the future process and you judge them. Like, are they responsive? Are they helpful? Do they make introductions? Do they go dark? Do they ghost you? Like, the contrast there is super important. If you don't have options, you may end up taking money from somebody you don't want to take money from. So my example with George Soros yesterday. I didn't know it at the time, but in retrospect, I'm like, oh yeah, that totally makes sense. I never asked for references of people he had invested in. Knowing what I know now, I'd ask. In addition to capital, what do you need? Like, do you need my industry knowledge? Do you need my brand? Do you need me to make introductions? Do you need me to be a coach? Like, be aware of what you need in addition to capital. Hey, Dave, I'm going to look for an independent board member who really knows marketing, because we can't afford to hire a VP of marketing, just a director of marketing. So we need somebody who can help on strategy. Great. I can introduce you to some people who would be great VP of marketing folks who could be independent board members, right? So know what you're asking for in addition to the cash. All the money spends the same way. And know that time kills all deals. So my observation as both a founder and as an investor is, if I like your deal, I'm going to pull your deal forward and get it closed. You don't have to push. If you have to push on the deal, you probably don't have a deal. So the longer deals take to close, and this is true when you sell your company as well, the longer deals take to close, the more challenging it is to get the deal actually closed. So time kills all deals from that perspective. All right. Questions about fundraising, either the process or kind of mechanics?
Dave, I have a question.
Yeah.
So ideally, the process in most of the accelerations that will take like 4 to 6 months, and afterwards there is a demo day that we pitch for potential investors. So do you think the normal process should be that we, within the 6 months of the acceleration, that we start to look for a follow-up investment within this small period of time? Because ideally, we when we go to whatever investor, as you mentioned, we put a runway like 2 months. So and now if you have the demo day or whatever, so we are going to pitch only within 6 months after we join the X phase. So this is the normal process, or you think it's just an introduction and we need to follow up with the investors because it takes another 6 months to close another deal?
I mean, it depends. I mean, really, the thing that's driving this is how much momentum do you get during the program, right? So the nice thing about demo day and the nice thing about the way FLAT6 works is they're going to create an audience for you at demo day, and they're going to create some feeding frenzy around you getting funded. So now you have to back into what can you and your team do in the 4 months that you're here to maximize that audience they're going to create for you, which is back to your milestones, product deliverables, traction, right? Revenue models and progress. So what you're trying to do is, instead of taking 12 months to get ready to raise funds, you should be able to, in 4 months, really accelerate that process. If you hit the milestones, you can find the funding at just after demo day, maybe even before demo day is done. A lot of deals get done before demo day is done, right? Because the investor knows, like, if I let you pitch at demo day, I'm gonna have competition. I'd rather get you a check sooner and set the price, right? Have it be reasonable. If you go to demo day, your price is likely to go up, right? It'll create competition for me. Keep in mind, investors are pretty simple folks, right? We're motivated by 2 things, and only 2, right? Fear of missing out and greed. So when you know that that's the case, the answer is, give me a reason to invest. Because if you give me a reason to wait, I'll wait, right? But if I know your price is going to go up at demo day, right, then give me a reason to invest and I'll invest. So just know that we're super simple, right? If I think somebody else is going to get the deal, I'll respond quickly. So other questions about mechanics, the 4-month process? Albert can answer any of this. You guys will get the process and talk with co-founders tomorrow as well as legal, but in general, fundraising process.
Just have a quick question here.
Yeah.
Regarding the point of making an investor wait. So in our case, for specific, we're undergoing like an iteration phase, not a full pivot, for example. So at this stage, we're also looking to raise fund. So in this case, that would be like shooting ourselves in the foot, doing our chances, you know, negatively or blowing them.
Yeah, I mean, if you have existing investors, they're likely, if they believe in you, they're likely, and I'm trying to do this at a meta level for everybody. If you take an existing investment and you found out that what your hypothesis wasn't actual, and now you need to iterate and change or pivot, and I still believe in you as a team, and you still have some money, you didn't burn through all of the cash trying to do that, you maybe burnt through half of the cash, then, and you tell me that you've done the customer development interviews and you've discovered a market that's bigger or you think is more viable, then the answer is, keep using the money to go pursue that next idea, or maybe I'll double down. But if I double down, I'm going to double my percentage of equity because the price of the company hasn't gone up. If anything, the price of the company has gone down, right? If I still believe in you, I'm going to be like, hey, go for it, right? Because as a VC, I don't want my money back. I want you to like roll the dice and go make me a return versus like, oh, I invested $1 million and I got back $300,000. I'm like, that's not great, but that's not like, I know I'm going to lose money on some deals, but I'd rather you, if I believe in the team, I'd rather you go swing for the fences, right?
Okay. Thank you.
Yep. Other questions about fundraising process?
Yes, Dave, please. So how to ensure that my investor is not going to push on me further, maybe in second year or something, in order to cash out and start gaining the money?
Only if they're not seasoned investors.
What do you mean?
So if as a VC, I expect to be in your deal 10 years. If I'm an angel investor who's never invested in tech before, and I'm like, hey, you know, I'm going through a divorce, or I need to buy a house, or the market blah, blah, blah happened, right? That'll happen, but you're not obligated to remedy that. Like, I understand they have a problem. That problem is not your problem, right? So if you sold them on the fact that they weren't getting the dividends, the fact that they weren't accruing interest, the fact that they were buying equity, like the best thing for the company is for the money to stay in. If you took the money out right now, it might be bad, right? So the expectation you should set with all of your investors is this is a long-term deal, and it should be in your, it should be reflected in your document. The level of risk should be reflected in your documents. And all the lawyers make sure that that's done correctly. And Albert's team of lawyers will make sure that's done correctly as well. But yeah, I've had that experience with angel investors because of life happening, like, family emergency or divorce or blah, blah, blah. But generally speaking, seasoned angel investors and real institutional investors are like, we want to run it out until you get maximize the value. And again, my reference to DocuSign yesterday, that was an angel investment for some folks that was 16 years. So it's super long investment process. Doesn't mean they won't ask you for it, but it also means you don't need to make it your problem. Other fundraising questions? Right.
So Dave, in the local market where we still have to see a large number of exits happening, either through buyouts or going public, one of the acceptable, I understand that VCs generally like to exit at a very late stage when it's either bought out or it's made public. But in this kind of market, don't you think that buying back the VC is also an acceptable exit as long as they get an acceptable, which is a good return?
Nope. You tried to sell this one yesterday too. I'm still not buying.
I'm not trying to sell. I'm trying to understand this. I mean, there's no reason for me to sell it to you.
No, I won't do it. So the deal is that if you're going really well and growing, I want you to keep so in venture, there's a thing called power law. So the idea of a venture power law is 1 or 2 or 3 of if I have 20 investments, 3 of them are going to return the majority of the fund, and then they're going to be in quartiles, right? So my top 3 of 20 are going to return the fund. And then I'm going to have, let's call it 18. So I'm going to have 6 companies that are going to make me money, but not make me a lot of money. I'm going to have 6 companies that are going to be zombies, right? They may or may not make it, but they're still kind of chugging along. And I'm going to have 6 companies that failed. I'm going to write off the bottom half, right? Mm-hmm. So the 12 that are zombies I'm like, do the best you can. If you get us something back, great, but I'm not counting on it. So if you're one of the ones that is in my top quartile, I want you to give me a big return. If I'm at the end of my fund life and you give me a return that's interesting, but that would usually take so much cash off your balance sheet that it wouldn't be worthwhile for your other investors. So if you approach me and said, hey, we want to do a deal where we're going to pay you back a dividend and we're going to give you a chance to earn your money back, that's a whole different investor profile. It's just not venture capital. So, and you may find one of those investors, but it won't be a VC, right? Because again, there's no way for me as a VC to take a dividend. And if I co-invest as an angel with VCs, I recognize I'm not going to get a dividend. Okay. All right. Last question, then we're going to go to groups. Okay. All right. So I'm going to break you all up into your groups now. And we're going to do 5 groups with the teams from FLAT6 and with me. So we'll be in 5 different groups and we'll divide you up into those.
Dave?
Yeah.
Yesterday, many of us dropped due to, we have sometimes we have unstable connection in Egypt. So some of us may drop outside. Is there any way around?
Speaking of unstable connections.
Yeah, okay, so yesterday we dropped and we couldn't join back. So I just want to make sure that someone is there to help us get back on the right team.
Yeah, that one's, I'll do my best. I won't promise anything because once I go to moderate my group, I'll see you pop in, but if I have to exit my group to come do it, then they don't get time either. So I'll do my best to get you back into the groups. A couple of you haven't put your company name in front of your name yet, so I don't know what group to put you in. So please do that now, and I'll make those changes. So if you haven't done that, please do that. Otherwise, you won't end up in a group because I don't know your company name yet off the top of my head.
Can I ask you a quick question, please?
All right, let me see.
Dave, do you hear me?
Beg your pardon? Go ahead.
Today, in the pitch exercise, we will have the same mentor or the same group. Or
You'll have a different mentor, but you will be with your teammates.
Yeah, same start. We will be as we as teammates, but with a different mentor, right?
Correct.
Okay, thank you.
This tool, I tell you, there's times. All right.
So we will create the breakout rooms now, but we'll start pitching at 4 p.m. so that the rest of the FLAT6 Labs teams can join.
Oh, great. Thanks.
So Rana, that means we have half an hour of break here.
Yes, exactly. You all have half an hour to either prepare your slides or just take a break.
Okay. Right. But we stay logged in.
So do me a favor, make
on.
sure your name is on it, stay on, otherwise I have to reassign you to the groups again, right?
Are we pitching the same pitch that we done yesterday, yeah? Or we...
Hopefully you've improved it. Based on
okay. That's what I mean, yeah.
Hopefully.
That's what I mean, like, not
So
other people, yeah?
You got
or even better, maybe there's a room for improvement.
I'm sure there is.
Definitely.
All right, so 30 minutes, we'll be back. Go work on your slides.
Sure, thank you.